The idea really is that we have guests, Steve Blank, Vivek Wadhwa. We've done 50 episodes. And the idea is that you come in and you tell a story, ideally that you've never heard before or told before. So I'll give you an example. David Bloomberg, who was a guest on the show, told a story of explaining social media to a sheikh at Davos. And so the story goes this way. One of the sheikhs says, Mr. Bloomberg, can you explain social media to us? And David says, sure. And he says, do you have children? And sheikh says, yes. Daughter is at school in London, and my son is studying at the university. And he says, do you remember what they were like when they were children? And he says, yeah. They played around the house, they talked to us, we had fun, and great children. And so David says, do you remember what they were like when they were teenagers? And he says, oh, David, they don't want to talk to us, they don't listen, they want to talk with their friends and play on the Facebook. And so David says, well, that's what social media is. Social media is wanting to connect with your peers and communicate with your peers. So this way instead of this way. So the sheikh says, David, he asks him a couple more questions. He says, David, best description of social media I've ever heard. But I have a question. How do we stop Facebook? So these kinds of stories, Danae, the founder of Indiegogo, was on the show. She talked about when she first met her co-founder, they went on a date, and she had a crush on him. And so she thought they had a great time, and he never called her back. And so, she was a little disturbed and bumped into him somewhere and said, what's going on with this? I thought we had a good time, we had a connection. And he says, you know what? I kind of like you, but I really like your idea, and I want us to be co-founders. And so obviously years later now, Indiegogo is a huge crowdfunding platform, which, by the way, started before Kickstarter. So anyway, so we've done 50 episodes of Technology in the Tent. We're now going to be distributing this ideally just in the Middle East, but we've had requests from India, from China, and some other countries as well to use this content for educational purposes. So the way I like to describe it is Larry King meets Bill Maher meets Khan Academy. I think Naval is here, so I want to welcome Naval, the founder of AngelList.
All right.
Naval,
this
welcome.
Is not a gimmick.
No, this is the tent. Welcome. So for those of you who don't know Naval, Naval is an awesome investor in I don't even know how many companies, but I think what you're most well known for is AngelList. And it's funny, in the beginning everybody's like, whoa, what is he going to do with this, and what can you do with it? And today I think AngelList does a little bit of everything in a sense.
Yeah, that's a bug, not a feature, right?
Sure.
Like any good VC would tell you, or any good investor would tell you to focus down on one thing. But the reality is what it's sort of turned into is a platform for startups. And today we help companies raise funding and also find talent. And in the future, we'll probably do a few more things. In that sense, it ends up being a little bit more like Craigslist or LinkedIn in that it's sort of a multi-purpose business network. And a little bit less than, say, like Twitter, which is very focused.
And so how many companies have profiles on AngelList today?
There's about 60,000 active profiles which are created and maintained by the companies. Then there's all these community profiles that are added by the community. Of those 60,000, something like 10 or 15,000 at any given point are what I would kind of put in the fundable category, because a lot of them are just aspirational. And then out of that set, probably between 2,000 to 3,000 have raised funding. And of that set, probably about half have raised at least some of that funding through AngelList. Obviously, we can't help everyone, so a lot of the companies that come on AngelList don't necessarily raise through AngelList, but they use it as a social executive summary, or they use it to get discovered by people who are browsing, or they use it to find talent.
So one of the features that I really like is, this, when an angel makes a recommendation or kind of backs a company and spreads it to their network. So tell me a little bit how that works and why that's so important, because I think a lot of times, the story you always hear is find a lead, and then ideally the lead should endorse you on AngelList, correct?
Yeah, so Definitely, it works well if you already have investors and they support you. They can share your company with their followers and their friends and kind of get the signal out. That drives about half the volume on AngelList of introductions. The other half comes from us reviewing the companies and sort of featuring the ones that look the most interesting for that given period of time. Thank you. It's very kind of you as a host.
And so last time I checked, the number was about $20 million a month. What is it now?
It's hard to measure because a lot of it flows offline. For example, Shervin Peshawar, who is at Menlo Ventures, he met Uber on AngelList when he was a seed investor, and then he ended up leading their Series C. We don't get credit for that Series C, so it just depends how you count it. When we've done the estimations, we've calculated it's about 10 million a month goes through introductions, leading to about 10 million a month in investments. And there's another 2 million or more a month that now we take entirely online, where we sort of had this crowdfunding for accredited investors, because that's the only thing that's legal right now, where you can write checks for a couple of $1,000s entirely online. And that moves about 2 million a month additional on top of the 10 million.
So you were a guest here 2 years ago, and the topic of your speech was the rise of the angels. Are they still rising?
Well, the definition of who an angel is increased broadly. A lot more people have gotten into it. And also companies these days just need a lot less money than they used to because there's so much leverage in the system. So the definition of who an angel can be has increased. The other thing that's obviously come up are the accelerators, who have become a very important, stable, and permanent part of the ecosystem. There was some question years ago whether they were all that important or whether they were capitalizing on a trend and whether they would stick around. Now I think you can almost think of accelerators do the job that angels used to, which was vet and invest in teams before there's any product. Angels do the job that seed funds used to, which is invest in companies maybe once they have a product but without too much traction. Seed funds are doing the job that VCs used to, and VCs are doing the jobs that perhaps later stage funds used to. Obviously, this is more true in consumer, where you can build something and launch it without needing a lot of capital. But we're now seeing accelerators and seed funds being prominent in hardware, in enterprise, and as everything sort of consumerizes. So the real underlying story is not about angels versus accelerators or VCs or AngelList. The real underlying story is just become a lot cheaper to build a company. And so the number of people who can be entrepreneurs is greater. The average stable company size is smaller, and that's the real revolution that's going on. We're going from a world with a few hundred startups, or call it a few thousand startups, and maybe a few dozen that matter, to we're going to a world with hundreds of thousands of startups, with thousands of startups that matter. And that's great for humanity. That's great for all of us.
Certainly. So one of the things you also do is you filter or do the application process for some of these accelerators. Tell us a little bit about how that works.
Yeah, that's right. So one thing we found was a lot of companies were coming to AngelList before they went to accelerators. They were kind of kicking the tires to see if they could get angel funding. And they were also building out these great profiles. So we turned that kind of into a one-stop shop for applying to accelerators. So today you can apply to 500 startups and Rock Health and Techstars and AngelPad and Mucker Lab and a whole bunch of other great accelerators, sort of almost one click through AngelList.
What is your general sense about these accelerators? Last time I checked, there's like 1,100 or so around the world now. A, do you think that it's going to be kind of the realtor syndrome where everybody thinks they can do an accelerator? And then B, do you think it's going to end up being that these accelerators are going to be verticalized based on very niche markets where they focus on either tech ed or fashion or whatever, mobile, whatever it is? Or what are your thoughts on that?
It's interesting. This is a power law business. So what that means is that the top 1, 2, 3% of the whatever account for all the returns. That's true for the top few startups account for all the returns in the industry. The top few venture firms make all the money. The top few accelerators get all the best deals. The top few angels make all the returns. And so there's this tendency where each class sort of looks down on the other and say, oh, there are too many of those. Yeah, well, there's too many of each of you. Sure. But it's just hard to tell in advance who it is. So although you can argue, for example, example, like the LPs like to say there are too many VCs. Oh, okay, sure, the top 10 VCs make all the money, but the definition of the top 10 changes all the time. I mean, arguably the number one today is Andreessen Horowitz, and they weren't around 10 years ago. Similarly, on the seed fund side, I'd say 8 out of the top 10 weren't around 10 years ago. On the accelerator side, yes, the top few are the most important, and a lot of the rest will suffer or do poorly or go out of business. But it's very hard to say in advance who the top few are. For example, we see amazing companies coming out of Rock Health and StartMate and UpWest and StartX and so on, and these are not considered to be the huge name brand big bang accelerators that were around 5 years ago. And if you look at internationally, 500 Startups is probably the #1 brand. Look at what they're doing in countries where other people don't even venture. There will, of course, be a shakeout, but there's always a shakeout going on in this industry. Every 18 months there's a shakeout where 90% of startups go under. That's just the nature of the business. So I would say people just have to be comfortable with that power law distribution if you're going to operate in this industry.
So one of the thoughts I have about accelerators that I don't think a lot of them have solved is the short-term cash flow issue. I mean, most of them, during my time at Founder Institute, most of these companies are really, really early. Yep. And so personally, I think a lot of these accelerators are doing a good job getting people started. But do you think there's still a kind of a gap right after and them not having funding? Some of them, like 500 Startups, have their own fund. But most of them
there's definitely a gap. And I think some of it just comes from a mismatch in the company expectations and valuation. When you look at, if you go into an accelerator today, say an average one is going to take 5 or 6% and give you $10,000 or $20,000. Well, your implied valuation there is really low. It's about $500,000. And then 10 weeks later, demo day, you stand up in front of angels, and you're suddenly supposed to be worth $4 to $10 million. Something's off there, right? Yeah. That much value didn't get created that quickly for the average startup. So I think those valuations have to converge. And so what we're seeing is a lot of the angels are starting to act more as mentors and get advisory shares or maybe move a little bit earlier. At the same time, we're seeing the accelerators themselves are starting to provide more upfront capital, often in conjunction with VCs. Y Combinator pioneered this with Start Fund, but now Techstars and AngelPad and others have their own version, where they'll essentially give you 50 or 60K before demo day at a certain capped note valuation. In fact, I can't give the details right now, but on AngelList, we have experimented with raising funds for an entire class from Accelerator before they sort of go out to the angels at demo day, and it seems to have worked pretty well, so we might be expanding that. Cool. So there's definitely a financing gap between the 10K, 20K an accelerator gives you, and then the $1 million round you're supposed to raise afterwards from angels. But I think that's going to converge. You're going to see the angel rounds shrinking and coming down in price. You're going to see the accelerator, what they're providing, increase.
Do you think that 50 or 100 grand is that bridge, or is it enough?
It might be. Mathematically speaking, it should probably be a little larger, but startups are scrappy. They're like cockroaches, right? They survive.
That's funny. There's another phenomenon.
In a good way. I'm a cockroach too.
There's another phenomenon. So Jonathan, Hackers and Founders, and Greg with Angel Hack are doing accelerators as well, and those companies are coming out of hackathons. A lot of people in the past really haven't believed that companies coming out of hackathons can make it, and they don't. But I look at it as, well, at least you have a technical talent on board, and then hopefully the rest should come easier. What are your thoughts on that?
Yeah, I think when you're doing a company, there's a couple of things to think through. First is, did you pick a good business and a good market? And that kind of thing only gets discovered over time. Like VCs and angels are good at sniffing out, no, that's too small of a market, or that's a bad business. But they're very bad at telling what is a good business. So just it takes time to prove that out. A second question is, can the team execute? And accelerators are good for that. Hackathons are even better at that because they're really quick. They put you under the stress microscope and make you produce something. And they really separate the people who can execute from the people who can't. So I think in that sense, they're a good thing. The third thing that I think neither the accelerators nor the hackathons solve is that startups are painful. To everyone who's doing one in the audience, it's an incredibly difficult thing. If you just read TechCrunch all day long, you're going to think it's really easy and great and everybody wins and makes millions. But the reality is it's just a lot of pain and suffering and misery. And most of my friends, even the ones who I know who are successful entrepreneurs afterwards, are really exhausted as human beings. One funny thing you can do is you can take like class pictures from like 1970 to now, and you can see how VCs age versus how entrepreneurs age. And it's just stark. Like the entrepreneurs look 20 years older when they're done. So it's not a pleasant process. So one of the things that I think the system does not yet know how to test for is how long are you in it for? The great companies are built by entrepreneurs who have been thinking about the problem deeply for a long time and are going to stick with it for a long time. The thing that you don't want is the first time the company hits a speed bump, because the company will always hit a speed bump, the entrepreneurs bounce out because they say, oh, my heart wasn't in this. And I would say as an investor, those have been my most disappointing outcomes. And it's the one thing that the accelerators and the hackathons maybe run in the opposite direction. But it's important for you as an entrepreneur, if you're starting a company, make sure you're in it for the really, really long haul, even if it's not successful. Because if you're not, it's very unlikely it's going to be successful.
And that long haul used to be 5 years. Now it's 10 years, 15 years?
I think it's always been 10 years.
10 years?
If you devote yourself to building a company and you work really hard at it, you probably will not have an opportunity for an exit until at least 5 years, and most likely 10 years if it's a large exit. There are always exceptions to the rule. You could say, Facebook for 7 years, but there are things like Apple that took a lot longer. There are some of the largest companies that we've seen built have been around for ages in one form or another. And you can start counting back from when they were projects first in the person's mind. But I'd say settle in for 10 years. I think the 4-year vesting schedule actually sort of cheapens the whole thing. There's a natural rhythmic reason why we're on 4-year vesting schedules. Colleges run on 4-year vesting schedules. Leap years and parts of the solar system run on it. So there's something deeply human about it, where we can stick with something for 4 years. But at the same time, it takes 10 years to build a company.
And so let's talk about this exit market. There have been less and less IPOs, so that market is broken. And then the IPOs that have happened, Groupon, Zynga, have almost soured the market a little bit. A friend of mine, Mona, is working on a solution for that. But what are your thoughts as far as the exit market, IPOs, smaller, these acqui-hires that are happening now?
Yeah, I mean, to an entrepreneur sitting in the crowd, I think talking about the IPO market is like, I'm trying to figure out which car to buy, and you're saying, well, we aren't putting enough people on the moon. Like, okay, sure, I'll deal with that problem when I get to it. There are enough IPOs in the sense that, I mean, come on, Zynga, like $4 billion or whatever they got for, making games and selling virtual goods. It's fine, it's good enough. And there are lots of exits going on. I mean, Tumblr getting bought for $1.1 billion is a gigantic payday for everybody involved. I mean, that's a company that's doing 13 million revenues. So I would say that there's still a lot of exits. There are enough exits if you build a great company, you will have a good outcome. The issue is just much more it's a very hit-driven business now. So are you going to be one of the 100 companies that makes it? And if not, you end up in an acqui-hire situation. The acqui-hires used to be much better for investors than they are now. These days, the corporate development departments, the acquirers, have gotten extremely good at separating the entrepreneurs from the investors. So they'll make sure the investors get back pennies on the dollar or maybe just a 1x return, and they'll make sure most of the upside goes to the entrepreneur. So that's smart on the corp dev team side, smart on the entrepreneur side, not so good for early stage investors because it's crushing their returns on these kinds of exits. So usually when you see an acqui-hire, it's basically a loss for the investors or maybe a tiny, tiny gain that's almost not worth the time.
And so is that market changing also as far as the actual dollar amount?
The dollar amounts are certainly coming down because there's a lot more of these companies that are out there to acqui-hire, and the acquirers are getting much smarter about locking the entrepreneurs down for 2 years, 4 years, 5 years, backloading the payments, putting stuff in escrow, just making sure they stick around.
One of the other things that obviously you guys do pretty well is for companies who want to hire. Tell me a little about numbers and how many jobs are posted and.
Yeah, so if you have 60,000 companies on AngelList, and if you assume that 57,000 will never raise any money, right, those people are eventually going to need jobs, or most of them will. And they're startup people. They're entrepreneurial. They want to work on startups. They understand how startups work. So we sort of created this little startup job marketplace. It's all self-service. No recruiters are allowed. Sorry if there are any recruiters in the audience. We just kind of went direct. The internet doesn't like middlemen. And so we just set up and it's a free matching service. And that's actually much bigger right now than the fundraising side. So we do about 500 introductions a week between startups and investors. We do 2,000 introductions a week between talent and startups. And these are mutual opt-ins. So both sides have seen each other's profiles and expressed interest. There's about 4,000 startups recruiting, and some of them are bigger. So even Uber and Yelp and Path and Quora and Kickstarter are on there now. And then on the other side, we have about 20,000 developers, designers, and so on. We have hired, our last 3 people that we hired came through AngelList Talent. And that's what we use as kind of our main recruiting pipeline. There's a huge number of people on there now. And many of them are in Silicon Valley, but a lot of them are recent computer science grads or engineers from outside of Silicon Valley who want to get in as part of the startup scene. So I think we may be, I don't know how true this is, but we may be at least partially responsible for reinflating the local real estate bubble. Because we're creating a way for out-of-market engineers and designers and product managers and salespeople to find startups. And it's the new sexy thing. Everybody wants to be in a startup.
Very cool. I saw an interview a couple weeks ago, I think TechCrunch TV. You talked about being able to almost see trends a couple weeks or a few weeks ahead of time.
Yeah.
So you're kind of fortune telling now as far as what the market is doing, or tell me what do you see and
Yeah,
the
market moves very, very quickly. There's a time when a certain kind of company is suddenly hot, and then there's a time when it suddenly becomes unfundable, and it happens almost overnight. And this happened with the daily deal space. This happened with subscription commerce. You could argue it's just happened with all of social media and apps. It happened with Facebook apps. These days, I think investors are looking a lot more for enterprise, for hardware, deep technology, stuff with traction. And it's just become very, very difficult to invest in anything consumer-facing until it has enormous traction. It's almost like in games, for example. You can't raise money for games from angels anymore, with very few exceptions. You almost have to build a platform layer or an underlying technology. And so the way that market now works is if you have traction, you almost skip to the later stage, maybe like a Supercell where the VCs do a big round, or you go straight to a cash business. And a lot of social medias seems to be heading the same direction. At the end of the day, Silicon Valley is Silicon Valley. It's a technology place. And so I think a lot of people are returning to their technology roots.
Very cool. Quick question also. Any advice as far as someone putting up a profile? A lot of the founders here are just getting started.
I mean, there's no magic to it. People keep trying to game AngelList. It's actually designed explicitly to not be gamed. What we look for is real-world signals. So the way we work it is we look at all your real-world signals, where you went to school, how much traction do you have, what space are you in, who do you have as an investor, as an advisor. And then based on that, we actually manually review the top companies. And we're always scanning them. Every time you update your profile, we rescan it. And if the company is one of the top few we feel that week, then we will feature it. But at the end of the day, it's not designed to be a system where you have to do anything fancy. You just have to create a great profile, and you have to have a great company. So if you're not getting funded on AngelList or otherwise, I think it is a mistake to go out there and pound the pavement harder and try and sell harder. Go work in your business. Bring on a co-founder who's an amazing developer, or ship your product, or get some early beta customers. Just move the business forward. At the end of the day, Silicon Valley is becoming a more efficient meritocracy. It's not a meritocracy yet. Nowhere is, but it's more so than anywhere else in the world. So you're always better off just moving your business forward rather than, I'd say, trying to network.
Well, because I mean, being at Founder Institute, they always had a rule, and that was don't put a profile up until you have a lead who can endorse you or send it to their network. But the whole process of raising money from angels is very time-consuming. It's kind of a pain. And like you said, a lot of the early founders are then spending a lot of time focusing on that when they should be focusing on product or business development or kind of deals.
Unfortunately, it is the job of a founder to always be selling. You're always selling customers, you're selling employees, you're selling investors. So you just have to have, someone on your team has to have those sales skills baked in. But that said, the most important thing is that you have something great to sell. So just keep moving your business forward. I mean, even AngelList, I get laughed at all the time. I get rejected. I've had VCs tell me it's a joke. So whatever, just keep working on your product.
It's an awesome product.
Product always wins in the end.
Very cool, and it's looking good. It's it's a big network, and so you guys are making.
Yeah, I think our product's okay. I think it's got a long ways to go.
There's a couple bugs.
Yeah, we're always overhauling it. We're always overhauling it. So you'll see in the next 3-6 months we'll rebuild the whole thing again.
How big is the team?
We're now at 13 people.
Wow. Yeah. Mostly technical, or?
Yeah, mostly technical. I'd say about out of the 13, 9 or 10 are basically work on product full time. We're very product focused. We don't have any BD, sales, marketing, or anything like that.
You don't really need it. I mean,
there's a temptation for it. The venture business is full of people who like to go to events and network and do coffees and market and all that stuff. And the industry already does it really well. We're not going to do it any better. So we try and focus on product because there's very little product being built in the venture industry. The talent marketplace was a surprise to us. It just seemed like a big, wide open gap. So we just built it and it just worked. Same way, you're going to see us doing more stuff, helping companies find acquirers, helping companies find customers. A lot of the stuff that gets done very ad hoc in the business that can be moved in the cloud and made systematic, we will make systematic.
So then in some funny way, you're Match.com for...
Yeah, Match.com is a good analogy.
For entrepreneurs and investors.
Yeah, and the same way, like if you're at Match.com and you're not getting a lot of dates, the answer is clean up your profile or maybe clean yourself up, make yourself a more desirable human being. It's like Charlie Munger, Warren Buffett's right-hand man, and he gets asked asked all kinds of crazy questions at Berkshire Hathaway meetings. And one of those questions he got asked once was, how do you find a worthy mate? And he just said, be worthy of a worthy mate. Right, so I think self-improvement, very Kaizen, is sort of always the answer.
Very cool. So we do something on the show, again, it's storytelling. The idea is that we want our guests to tell a story about a component of something they've experienced along the way, ideally that they've never told before.
Right.
So we talked about this, and you were thinking, have you come up with something?
Right, so we talked about this like 10 minutes ago. So he sprung this on me. Give me a great story you can tell on stage that you've never told anybody before. And I kind of, at that point, like your entire life flashback happens, right? And you're like, well, I'm really not that interesting. Not that much has happened. So I kind of reject your premise. Thank you for trying. Instead, what I'm going to offer up is, I kind of look back at a lot of stories in my life. And, I came here as an immigrant, first generation. And so there are a lot of neat little stories. But what I find is that I read these same stories, right? You go on the web, somebody writes a great blog post, someone tweets something out, you go follow up and you read this story and you're really inspired. You're like, this is going to change my life. And you put it and you read it later or pocket or instant paper, or you pin it to your wall or whatever. And you're really inspired. And then 3 days later, it's out of your mind, you've forgotten, and you're done, and you're on to the next piece of inspiration. So rather than leaving you with some apocryphal inspiration, I want to leave you with a framework.
Okay.
And when I look back on my life and kind of the stories that made a difference to me, they all kind of fall within this framework of compound interest. I think a lot of the great things in life come out of compound interest. Warren Buffett is one of the richest self-made people in the world, if not the richest, because he believes in compound interest. He'll hold every dollar to the end. He doesn't want to spend anything. Anytime he's spending $1, he does the math on what it'll be worth in 30 years, compounding at 20%. And he's just like, I can't buy that hamburger. That'll cost me a fortune, right? And so he makes a lot of money because of that compound interest doctrine. And I would say that it applies to every aspect of your life. And the three most important things are your work, your health, and your relationships with people you care about. And I would say, one of the things about Silicon Valley is it really sometimes pushes into a short-term mentality because everything is very competitive, everything's very frothy, everything's happening very quickly. But what you realize is once you've been in the Valley 15, 20 years and you get a little older, is that all the stories that matter to you are the ones where they're with people who are still in your life and will be in your life 20 years from now. Or all the money that you make is in businesses that you stuck with for 10 years beyond any rational investing schedule. Or even your health, to the extent that you're in good shape as you get older, it's because you've kept up a diet that you could keep up that was natural for you, or you found some hobby that you like to engage in that got you into shape. So I would say, anytime you're making a decision, whether who to work with or who to spend time with, or what to work on, or what health regimen to follow, just ask yourself the simple question, will I be doing this 10 years from now? Will I be doing this 20 years from now? Because if you can't do it 10 or 20 years from now, if you won't be, you're going to get none of the benefit of compounding out of it. And all the benefits come from compounding, all of them. So at the end of the day, what separates the winners from the losers is just putting one foot in front of the other and just doing it long enough. So just make sure that it fits into this compound interest framework.
So patience, consistency.
Yeah, and you know, that's where all the do what you love stuff comes from. It sounds cheesy, but the reason they keep saying it, the reason it's true, is because if you love it, it's not work, and if it's not work, you'll stick with it.
Yeah. So one other thing we do on the show, and I didn't tell you this, but it's called old rules. Okay. So what's the #1 rule you live by when you get up in the morning? Like what drives you, or what's the the foundation of Naval, and what drives you?
Yeah, you know, I think the kind way of saying is I like to be productive. I like to always be doing things. I'm very action-oriented. The unkind way is I'm very impatient. Right?
Impatient?
Impatient, okay. Yeah. I just don't like to see inefficiencies. I don't like to see things that don't work well. There's a big belief, especially in Western culture, that you have to find happiness. I grew up more Eastern culture, where happiness is not really a virtue. Nobody asks you all day long, like, are you happy? Are you doing everything to maximize your happiness? It's more, are you useful? Are you effective? Are you virtuous? You know, I don't have a single rule that I wake up or go to bed with, but I sleep pretty easily, and I think that comes from having a sense of purpose. And for right now, and for a long time, you know, AngelList and startups are my purpose. And when you kind of have that, you sort of don't question all the little things. It's like in a good relationship, when you match up with someone, your values match up, and then you don't argue over little things.
That and some good investments that you've made, right?
And I made a lot of bad ones.
Okay, good. Yeah. So we want to take some audience questions. If anybody wants to ask Naval a question, raise your hand. There's a mic here.
Or if someone needs baklava.
Yeah,
we have baklava quite a bit.
Yeah. Any questions? Come on. This is your chance. Up there. You want to scream it?
I've got one. I'll shout it.
Go ahead.
So, with so much focus on improving effectiveness and efficiencies with all systems, especially the investment systems and startups, why do so many continue to fail? Shouldn't that be improving by now more dramatically? Or perhaps it is, but it's not noticing?
Yeah, so why is the hit rate so low? You know, it's a really good question. So the hit rate is low in the context of people who have never really done anything before and have no resources are trying to build billion-dollar businesses, right? You would expect that to be an efficient market. So to the extent that it gets easier to build a business, to the extent that it gets easier to zero in on what to do and how to do it and who to do it with, and gets easier to raise the capital, what happens is it's not quite a zero-sum game, but it gets very competitive. More and more people fill the gap. I think to some extent it's because there's a lot of competition. People are going after very large prizes. And I think partially also these are just extremely hard problems. By their definition, the kinds of problems most startups are trying to solve, no single human being knows the answer to. A lot of times you don't know whether someone's going to use your product until it gets to market in scale and enough people try it and test it. So you're literally trying to guess the actions of millions of human beings, and nobody's smarter than everybody. So in that sense, it ends up being more of a problem like evolution, trying to adapt to some new change in the environment and having to iterate and iterate and iterate until it gets there. And it's an unfortunate nature of the beast that the person who happens to be at the right time and gets it there in the right way gets all the credit, and someone who was there just a little earlier or got it just a little wrong or showed up just a little later gets almost none of it. So it's not a fair world that way.
Jonathan Abrams.
Yeah, I mean, Friendster, MySpace, there's lots of examples. I think, unfortunately, it's an efficient market, and people are relatively efficient, and it is very competitive. What does work well, though, is I found that entrepreneurs rarely lose over their careers. So if you stick with it for 20 years, you keep trying, you keep doing various things, eventually something's going to hit. And you only got to hit once, because the upsides are so large. And you can lose multiple times along the way. But it is very hard to deterministically win in one move. Because if you could, everybody else would do it.
Very cool. Another question?
Hey, Naval, thank you for coming today. I have two questions. One is, about 2 years ago, maybe even a year back, everyone was talking about convertible notes and it was like, oh, uncap, cap. But now it seems like people are going back towards equity rounds for seed rounds. What is your idea on, the best way to raise your first seed round, convertible note, or just regular equity? And the second thing is, a lot of VCs are, not looking at consumer anymore. especially in e-commerce, there's a lot of people, are looking negatively at that. If you were recommending an e-commerce company that was trying to raise money, is there a metric we should try to hit or we should aim for before we go out and raise money?
Yeah, so the first question is convertible debt versus equity. Second is about e-commerce financing. Convertible debt versus equity is a little bit of inside baseball. The reality is that most investors prefer equity. Everything else equal, if you can do it, do equity. Convertible debt does have some advantages. It allows you to move the pricing around. It makes the closing cheaper and easier. So if you have enough leverage to do convertible debt, you can do convertible debt. There's enough written about it on the web that I won't bore the rest of you with all the fine checkmark details. Sure. On e-commerce companies getting financed, e-commerce is a very broad category. At the end of the day, investors, the way this market works, for better or for worse, is it does not finance predictable, one foot in front of the other, low margin, slow growth businesses. Everyone's looking for that big bang that's going to return 100x or 1,000x their capital. And so because of that, anything you're building has to have this potential for nonlinearity. So even in an e-commerce business, if you really want to get financed, you have to show that you can get to a really large outcome and a really big nonlinearity. And that may come from doing some fundamental underlying technology with huge margins. It may come from just you're already so large and gotten so big that there's scale effects like with Amazon. But it's a hard problem. I guess I would focus on the technology side of it, the network effects side of it, on lower customer acquisition side of it. The e-commerce businesses that are interesting to investors these days are companies like Pinterest and Wanilo, where they have no cost of customer acquisition, they're not carrying inventory, and they're selling other people's products. And the e-commerce companies that are less interesting are the ones that are carrying and shipping and moving products. If you have one of those second kinds of businesses, it's not necessarily a bad business. It can be a fine cash business. It might be a business you build with alternative financing. But by raising venture or angel, you probably will turn it into a bad business, because then you'll be forced to try and figure out how to make an inherently linear business nonlinear. And there's nothing wrong with linear businesses. Every business on the street outside on Broadway is a linear business. Those are real businesses. But they don't go running out thinking they should raise venture capital.
Do you think that this idea of building billion-dollar businesses has in some way tainted entrepreneurship as the root of what it really means? Because again, like you said, most companies won't make it, but I think a lot of people
I think so. I think we have sort of overloaded the term entrepreneurship. We use it to mean a very specific kind of Silicon Valley style business where you raise a lot of money, you try really hard, go big or go home. Yeah. And that's not what entrepreneurship means. There's a lot of great entrepreneurs out there who are unrecognized and don't get to go to these cool conferences and think of themselves as anything special because they're doing a normal business, which is still every bit as entrepreneurial. To those of you who have had family members who have done small businesses, it's no easier and probably much harder than what we're doing. They just don't get the credit because it doesn't look like they're trying to build something nonlinear. And I think the industry needs to support those kinds of businesses more. Part of the problem there is a lot of those businesses are cash businesses, right? So it's very hard to track the money. So how do you get paid out? How do you exit? How do you make sure there isn't fraud? There's also another issue, which is our tax code doesn't reward funding those kinds of companies because dividends get taxed at a much higher tax rate than capital gains. Yep. So you're only looking for businesses that can have an exit. So there are issues there, but hopefully they can get solved.
Is crowdfunding the answer to that?
Crowdfunding is definitely better for those kinds of businesses than I think any other model to date has been. That said, even with crowdfunding, if you're funding your local restaurant chain or taco truck or whatever, those are cash businesses. So how do you do the accounting? How do you make sure there isn't fraud? That's an issue. Yeah. And then how do you do disbursement of dividends to such a large number of people and you still have the tax inefficiency?
Another question?
So apart from the scalability of the business you're looking into, what from an angel's perspective would be the top 3 criteria you base your decision upon whether to invest in an idea or not?
So what are the top 3 criteria for an angel on whether to invest in a company or not? So investing is actually an emotional decision. It's not a rational decision. Sure, your brain enters into it later. But early on, I think most of the time, angels invest in a company because they fall in love with an idea. And they fall in love with something about the company. And usually it's either they really like the team and they connect and they bond with them and they feel like they're really good people, or they really like the product, they have an affinity for it, they feel like they've used it or they would use it, or they're just blown away by the traction. They just see the growth month after month after month, or they're brought in by a friend of theirs who's also investing, some social proof, some high signal person, and they use that to anchor off of. So it is kind of an emotional decision. And I think it's much better to stand out incredibly in one respect than it is to try and be pretty good at everything. Because you don't create a great company by being pretty good at everything. You create a great company by being really, really, really good at one thing.
Doing one thing.
So it's good to stand out in some way. There's a lot of noise out there, so you have to put some signal through.
Okay, ladies and gentlemen, we want to thank Naval. We have something, a gift. We have a Pit Me T-shirt that you can wear. They're actually pretty comfortable. Yeah, and this is a Shafia from Palestine, actually.
Oh, wow.
A friend of mine gave me. So
Great.
We call it the traveling Shafia. Tim O'Reilly and I exchanged them. I've done this like 4 or 5 times, but it's a gift from somebody that I pass on. So hopefully you like this. Thanks a lot, Naval. Great to have you in the tent.
Thank you.
Look forward to staying in touch.
Thank you.
All right. So we're going to break this down and give us a couple of minutes, and then we'll get going again.
Thank you, everyone. And then out of that set, probably between 2,000 to 3,000 have raised funding. And of that set, probably about half have raised at least some of that funding through AngelList. Obviously, you know, we can't help everyone, so a lot of the companies that come on AngelList don't necessarily raise through AngelList, but they use it as a social executive summary, or they use it to get discovered by people who are browsing, or they use it to find talent.
So one of the features that I really like is, you know, this, you know, when an angel makes a recommendation or kind of backs a company and spreads it to their network. So tell me a little bit how that works and why that's so important, because I think a lot of times, you know, the story you always hear is find a lead, and then ideally the lead should endorse you on AngelList, correct?
Yeah, so definitely it works well if you already have investors and they support you. They can share your company with their followers and their friends and kind of get the signal out. That drives about half the volume on AngelList of introductions. The other half comes from us reviewing the companies and sort of featuring the ones that look the most interesting for that given period of time. Thank you. It's very kind of you as a host.
And so last time I checked, the number was about $20 million a month. What is it now?
You know, it's hard to measure because a lot of it flows offline. For example, you know, Shervin Pishavar, who is at Menlo Ventures, he met Uber on AngelList when he was a seed investor, and then he...
Wait, so the sheikh says, David, he asked him a couple more questions, and he says, David, best description of social media I've ever heard. But I have a question. How do we stop Facebook? So these kinds of stories, Danae, the founder of Indiegogo, was on the show. She talked about when she first met her co-founder, they went on a date, and she had a crush on him. And so she thought they had a great time, and he never called her back. And so, you know, she was a little disturbed and bumped into him somewhere and said, you know, what's going on with this? You know, I thought we had a good time, we had a connection. And he says, you know what, I kind of like you, but I really like your idea, and I want us to be co-founders. And so obviously years later now, Indiegogo is a huge crowdfunding platform, which by the way started before Kickstarter. So anyway, so we've done 50 episodes of Technology in the Tent. We're now gonna be distributing this ideally just in the Middle East, but we've had requests from India, from China, and some other countries as well to use this content for educational purposes. So the way I like to describe it is Larry King meets Bill Maher meets Khan Academy. I think Naval is here, so I want to welcome Naval, the founder of AngelList.
Ended up leading their Series C. We don't get credit for that Series C, so it just depends how you count it. When we've done the estimations, we've calculated it's about $10 million a month goes through introductions, leading to about $10 million a month in investments. And there's another $2 million or more a month that now we take entirely online, where we sort of had this crowdfunding for accredited investors, because that's the only thing that's legal right now, where you can write checks for a couple of $1,000s entirely online. and that moves about 2 million a month additional on
Very
top
cool.
of the 10 million.
So you were a guest here 2 years ago, and the topic of your speech was the rise of the angels. Are they still rising?
Well, the definition of who an angel is increased broadly.
Okay.
A lot more people have gotten into it. And also companies these days just need a lot less money than they used to because there's so much leverage in the system. So the definition of who an angel can be has increased. The other thing that's obviously come up are the accelerators, who have become a very important, stable, and permanent part of the ecosystem. There was some question years ago whether they were all that important or whether they were capitalizing on a trend and whether they would stick around. Now I think you can almost think of accelerators do the job that angels used to, which was vet and invest in teams before there's any product. Angels do the job that seed funds used to, which is invest in companies maybe once they have a product but without too much traction. Seed
The idea really is that we have guests, Steve Blank, Vivek Wadhwa. We've done 50 episodes. And the idea is that you come in and you tell a story, ideally that you've never heard before or told before. So I'll give you an example. David Bloomberg, who was a guest on the show, told a story of explaining social media to a sheikh at Davos. And so the story goes this way. One of the sheikhs says, Mr. Bloomberg, can you explain social media to us? And David says, sure. And he says, do you have children? And sheikh says, yes. Daughter is at school in London, and my son is studying at the university. And he says, do you remember what they were like when they were children? And he says, yeah. They played around the house, they talked to us, we had fun, and great children. And so David says, do you remember what they were like when they were teenagers? And he says, oh, David, they don't want to talk to us, they don't listen, they want to talk with their friends and play on the Facebook. And so David says, well, that's what social media is. Social media is wanting to connect with your peers and communicate with your peers. So this way instead of this.
All right.
Naval,
This
welcome.
is not a gimmick.
No, this is the tent. Welcome. So for those of you who don't know Naval, Naval is an awesome investor in I don't even know how many companies, but I think what you're most known for is AngelList. And it's funny, in the beginning everybody's like, whoa, what is he going to do with this? And what can you do with it? And today I think AngelList does a little bit of everything in a sense.
Yeah,
Connecting
that's a bug, not a feature, right?
Sure.
Like any good VC would tell you, or any good investor would tell you to focus down on one thing. But the reality is what it's sort of turned into is a platform for startups. And today we help companies raise funding and also find talent. And in the future, we'll probably do a few more things. In that sense, it ends up being a little bit more like Craigslist or LinkedIn in that it's sort of a multi-purpose business network. And a little bit less than, say, like Twitter, which is very focused.
And so how many companies have profiles on AngelList today?
There's about 60,000 active profiles which are created and maintained by the companies. Then there's all these community profiles that are added by the community. Of those 60,000, something like 10 or 15,000 at any given point are what I would kind of put in the fundable category, because a lot of them are just aspirational.